I liked Aries Capital back in July when it was yielding 8.8%. Now it's yielding 9.5%, and I like it more. As I explained here, BDCs have been oversold recently, and that spells opportunity. Today, we'll get up to speed on what's been happening with the biggest BDC of them all. If you like consistent income and a 20-year history of outperformance, this episode will be for you. Hi from Central France once again. This week we're exploring tunnels under the castle, and next week I'll go back to Asia. Okay, let's get into the distribution history then. The ARCC distributions look good. There was one cut back in June 2009 following the global financial crisis. It fell from 42 cents down to 35 cents, then took almost 13 years to climb back to 42 cents before reaching its current level of 48 cents. The dividend was unaffected by the pandemic of 2020, the bear market of 2022. Actually, they paid out some special dividends that year, the regional banking crisis of 2023, or the recent drama over Tricolor and First Brands. BDCs sometimes distribute special dividends if they have an unusually profitable quarter. ARCC is a fairly conservative company, so they don't pay them as often as other BDCs, but when they do, it's a nice surprise. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. Aries Capital Corporation, ticker ARCC, is a business development company, or BDC. The yield is much higher than a typical dividend stock like Coca-Cola that pays less than 3%. The reason is that just like REITs, BDCs are structured as regulated investment companies. That means they're required to pay out at least 90% of their net investment income as dividends to investors. Their incentive to do that is that the RIC structure exempts them from paying corporate taxes on that income. Quick tangent. Dividend stocks like Coca-Cola deliver most of their returns as appreciation, not dividends. If you're curious as to whether one of Warren Buffett's largest holdings, roughly 10% of Berkshire Hathaway, holds up well against ARCC, here's the total return chart going back 21 years to when ARCC was first listed in October of 2024. Coke is good, but I would argue Aries Capital is better. By the way, if you're new to the channel, I retired back in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Okay, back to BDCs. They typically lend to medium-sized businesses. Much like a bank, the BDC makes money from the interest they earn on loans. Unlike a bank, though, BDCs also have the option in some deals of taking an ownership position in the borrower's business. Under that scenario, they're even more motivated to help the growth or development of the business they lend to. I said they pay out at least 90% for favorable tax treatment. The small amount they retain for themselves isn't going to allow them to grow much. So it's reasonable to assume that if you invest in a BDC, most of your returns will be in the form of dividends rather than price appreciation. Another key difference between a BDC and a bank is their source of funds. Banks get their money from, us, from customer deposits. So banks rely on customers not withdrawing too much at any one time. In other words, a bank run. For this reason, banks rely on the government to regulate them so the public trusts them to hold their money. They may also rely on the government to bail them out if there's a problem. BDCs don't take deposits. They borrow at a low rate, then lend out at a higher rate. If we boil it down to the weighted average, using this chart from ADS Analytics, they're borrowing at just over 5% and lending out at just under 11%. The difference between those two numbers is their income. Also worth noting that both numbers rise and fall with interest rates, but the blue line, the money coming in, rises and falls more dramatically. If interest rates trend lower, ARCC will eventually refinance their debt at a lower cost. Apart from the yield, here's what I like about ARCC. Ares Capital is the largest BDC by far. It's not even close. This gives them quite a few advantages, including access to larger deals that their competitors can't touch, and more market data from their huge loan portfolio. That data helps them make better underwriting decisions when deciding whether or not to fund a loan. The net asset value is trending up, which is a good thing. NAV is simply assets minus liabilities. The assets are income-producing loans. A loan default means that one of the assets becomes less valuable, so that would push NAV down. If they sign, say, new loans at more favorable terms, or their equity positions rise in value, that would push the NAV up. The higher the NAV goes, the greater the potential future returns of the BDC. A rising NAV isn't usually a huge deal for ARCC. It's pretty common, but given the recent nervousness of the market around credit, I think it's reassuring to see the NAV continue to rise. Financial statements are important, but it's the earnings calls that give you a sense of where management's priorities lie. Thanks to Matt B for pointing out this quote from the Q3 call. CEO Kurt Schnabel said, "In 2022 to 23, we intentionally set our dividend at a level equivalent to a 9% to 10% return on equity, which is a level we have historically achieved through different interest rate cycles over the last 20 years. We set the dividend at this level because we believe we can sustain this level of profitability through market cycles." In other words, he's saying that they made some extra cash when rates were high, and even though they could have paid out more, which probably would have boosted the stock price and their bonuses, they put some aside for a rainy day. And the rainy day fund is known as undistributed taxable income, or Spillover, and it's currently $1.26 per share. The current dividend is 48 cents per share, so even if there were a few cents short down the road, there's plenty to top it up if needed. Now, earnings calls are typically pretty long. The transcript for this one was over 11,000 words. Seeking Alpha has a new feature that summarizes key points using AI. You just click here and it's easy to digest, including the responses to questions that are asked by analysts. It's good for like a quick take, but to get a deeper understanding, I still want to hear from a human. For more detail on ARCC than I can possibly cover in a 10-minute video, I suggest reading Samuel Smith's analysis of ARCC. It was published on October 29, so it takes into consideration the Q3 results that we're referring to today. I don't buy or sell any income investment without first reading analysis by humans on Seeking Alpha. I'll put a link to Samuel's article in the description, and I'll include a link for a free trial and a discount. One last point about ARCC's conservative management. They're transitioning the portfolio to more first lien loans. First lien means if the borrower defaults, they're first in line to receive the funds from the sale of loan collateral, they meaning ARCC. This hasn't been an issue for ARCC because historically, they haven't had many defaults. But going into a period of economic uncertainty, having more first lien loans is a way to reduce risk. Speaking of defaults, a leading indicator of the risk of defaults is the non-accrual rate. It measures the percentage of portfolio loan value that is behind in payments by 90 days or more. ARCC's current non-accrual rate is 1% by fair value, which is about normal. You can see the shift to first lien loans here, and last quarter, new loans were almost completely first lien. For the negatives, I struggled to find a lot for ARCC. Reading through past analysis on Seeking Alpha, the two criticisms were, number one, it's overpriced, and as I record this, that's not the case. More about that shortly. And number two was the lower percentage of first lien loans than the competitors. And that's true, but as we saw earlier, it's not really a huge deal, and they're doing something about it. If interest rates continue to decline, it will reduce income for ARCC until they can refinance their cost of debt, but it's the same story for all BDCs and all floating rate credit investments. Also, everything's relative. If short-term treasuries remained at a 4% yield and BDC yields dropped from, say, 10% to 9%, that would make BDCs look slightly less attractive. But if they both drop by 1%, then BDCs still offer a reasonable reward for the risk taken by the investor. BDC valuations are typically expressed as price divided by NAV, also known as the price to book ratio. ARCC is at 1.03 times NAV as I record this. Now that's expensive for a low quality BDC, but for a high quality BDC like this one, 1.03 is not expensive. This 5-year price to NAV chart gives some context. If you really want to time it, you could put orders in to buy it below 1 times NAV, but I'm not a trader. I mostly just hold, and I make the occasional trade when there's an obvious opportunity. By the time you watch this video, the price of ARCC will be higher or lower than when I recorded this, so I'm not saying rush out and buy it now. My point is kind of the opposite. For income investments, the timing matters less than it does for growth investing. You don't need to buy low and sell high, you just need to buy something that produces consistent income. Also, just because the stock price goes down doesn't mean the business goes down. If ARCC did change its strategy, just something that I didn't like, or its income stream fell dramatically, I would sell it. But selling just because the market price of the stock goes down isn't something that I'm considering. In fact, if my allocation was smaller, I'd be adding to it at the moment. I currently have a 5% allocation to ARCC, which is my cap for individual investments, and I'm comfortable holding ARCC for the long term. Before I go, I mostly make videos about investments I like, but I like some more than others. If you want to find videos of my favorites, click here for reviews focused on my top 10 holdings. That wraps it up for this Aries Capital update. More Armchair income coming soon.